These stocks have been falling, so in today's video I'll be covering stocks that have been falling after their earnings report, as well as some other stocks that I hold in my portfolio. And for reference, this is my portfolio here. I update this weekly on the channel, so feel free to check it out. So in today's video, the first stock that I'll be covering is actually Netflix. So Netflix is down around 10% today after their earnings release. And if you have to look at their earnings report, it was actually quite decent in terms of revenue growth. So revenue grew by around 17% year on year, and they're guiding for around 16.7% revenue growth next quarter. And the reason why the stock is down is because their net income actually came below expectations. So they had a one-time tax expense that they had to pay in Brazil. So that actually hurt their bottom line, and that's why the operating margin over here is a lot lower than last quarter. It's around 28% this quarter, and their EPS also came in below expectations. So I think this is an overreaction for Netflix, but of course the markets can remain irrational for a very long time. And for Netflix, they have been continually gaining market share in US TV time. So over here, as you can see, US TV time for Netflix has been growing. It has gone from around 7.5% in 2022 all the way until 8.6% this year. And they're expected to continually grow this portion, with Netflix taking market share away from traditional TV. And for Netflix, the company is fundamentally quite strong. Revenue growth of 17% for a company that is as big as Netflix shouldn't be understated. So the reason why the stock is down, the only reasoning that I think is fair, is the high valuation of the company. So the company before its earnings report was actually trading at around a 55 times price to earnings, and currently is still trading at a 46 times price to earnings. So on a PE ratio basis, the stock is still expensive, but on a historical basis, this is probably close to its mean for this company. I think for Netflix, the 46 times earnings is probably elevated. The company is now expecting around a 20 to 25% EPS growth over the next 5 years to justify its current valuation. So for Netflix today, although the 10% drop is unjustified, the high valuation is probably the reason behind it, and I wouldn't add into Netflix at today's price. The stock is still expensive. The next company that I'll be covering is actually a holding of mine. It's Moody's. So Moody's year to date is pretty much flat. They actually dropped after their earnings report despite raising guidance. So for Moody's, the thesis is extremely simple. It's just your debt wall maturity coming up, and with interest rates coming down and with your refinancing walls increasing over time as well, this is bullish for a company like Moody's. And for Moody's, besides that, the company actually raised their earnings outlook this year. So the company is projecting around $13.15 to $13.40 of EPS this year. The company has raised their guidance, and despite that, the stock actually fell after its earnings report. So for Moody's, overall the earnings were quite good. So your debt wall maturity is coming up, your interest rates are falling. That is bullish for a company like Moody's. And with your data centers and your need for credit increasing over time, this is bullish for a company like Moody's. But of course, Moody's is trading at a premium. If you're looking to buy into a company that is in this credit rating portion, I think S&P Global is the better buy today at around a 26 times price to free cash flow. Moody's is still currently trading at a 31 times price to free cash flow on this 2.5 billion metric here. So I would avoid this company. I would just buy S&P Global if I'm looking for a credit rating company to own. Of course, they're both high quality, it's just on a relative basis. S&P Global is offering the better price today. Next portion, I'll be covering Google. So Google's stock was actually down around 4% after the ChatGPT announcement. And then soon after that, they actually had a deal with Anthropic, which bumped up the stock price back up to all-time highs. So if you didn't know, ChatGPT actually came out with their new browser system. It's basically an extension at this point. They released a lot of features that were similar to what Google already had in Gemini. So this wasn't anything innovative, it was just them creating something new, them extending their ecosystem. I don't think it's something that is groundbreaking. I don't think it will hurt Google Chrome to a very large extent. But of course, OpenAI is actually targeting a $200 billion run rate business in 2030. So I think the only way for them to reach that is through ads. I don't think the subscription revenue can keep up at this rate because, as you can see from the numbers, the growth is actually falling already. And so I think the most profitable business model that they can go for is ads. And what they didn't say yesterday is them pursuing ads. So if in the future ChatGPT were to pursue ads as well, similar to what Google and Meta has done very well, then my take is that Google's core business is under attack by ChatGPT. So Google's core business is great, but with the increasing need for innovation, and with ChatGPT pursuing ads in the next few years, then this could actually hurt their ad business, because someone has to lose their ad dollar. So the core business could see weaknesses in the future. Of course, the other businesses are all doing very well, but without search, Google is still weak for now, at least for the next 2 to 3 years, unless the cloud portion as well as the YouTube portion can grow to an extent whereby Google is no longer reliant on search. I don't see that as being true anytime soon. And then on the same day, ironically, Google actually went up by around 3% after this deal with Anthropic. So this deal is actually by Bloomberg. It says Anthropic and Google are in talks on cloud deal worth tens of billions of dollars. So Anthropic is in discussion with Alphabet about a deal for cloud computing services valued in high tens of billions of dollars. The plan involves Google providing cloud computing services to Anthropic, with talks in their early stages and details subject to change. Anthropic recently closed a $13 billion funding round and has received investments from Google, Amazon, and other firms to advance its AI capabilities. So ironically, Google on the same day actually went up by around 3% after this report came out, and Amazon went down in stock price. And I was discussing this with a friend who was telling me that Amazon is getting hurt by this portion here. And my thoughts are as follow. A lot of these deals are actually seller financed. So if you look here, Google actually invested in Anthropic, and now Anthropic is investing that money into Google. So it's seller financing loop that keeps going on. And a lot of these deals are arbitrary. It's impossible for you to predict with certainty how all the clouds will continually grow. And without return on investment for all these cloud computing companies' customers, this could eventually come back to hurt all these AI cloud computing companies, like your Google, your Amazon, your Microsoft. So I think a lot of this AI hype right now is overstated, and it's a seller financing loop that keeps going on. And as someone with a lot of his net worth in Google stock, I think it's something that you should be wary about. It is probably a bubble brewing already. Of course, it's not at levels in 1999. I wasn't old enough to live through that day. But it is definitely something that could be in the works of a bubble today. So be cautious of all these different deals. And yeah, a lot of it is arbitrary. No one knows what exactly is going on behind the scenes. No one knows how to project all these growth numbers. It's all just guesswork. Next portion, I'll be covering Mercado Libre stock. So this is a stock that I've been covering for quite a fair bit already over the past few videos. Stock is up around 20% year to date, down around 20% off of its highs or so. So Mercado Libre is particularly interesting because it's in Latin America. It's an emerging market that is growing rapidly because of digitalization as well as globalization. So I've actually been watching a lot of Argentina vlogs to see how they pay for their food, how they pay for all the different services, and so far it is largely untapped. Most people are still paying with cash. And for Mercado Libre, the business is particularly intriguing because they have an ecosystem that is brewing. So they're similar to Amazon plus PayPal combined together into one. And for Mercado Libre, they have two different business lines under them. I know I've said this one before, but they have their commerce platform where it's similar to Amazon. So they have their third-party seller services. They do their first-party selling as well. And they have advertising in that portion. And then in their fintech portion, they have consumer credit. They lend money to merchants and they provide credit cards as well. So for Mercado Libre, the good thing about the business is the synergy between the two. So when people buy on their platform, they need to use the Mercado Libre payment system to get rewards and so on. And then besides that, the merchants on their platform can also loan money from Mercado Libre through the Mercado Pago portion. It's called Creditos or something similar to that. So it's a flywheel effect with great synergies between the two. So for Mercado Libre, the theses will be as follows. First of all is your Latin America growth. So this one is one that everyone is talking about already. It's probably priced into the stock. The stock is projected to grow by around 20 to 30% over the next few years, of course. So that portion is probably already priced into the stock. And then the other thesis would be that the company is actually acquiring customers at a much lower cost as compared to traditional banks. So in Latin America, majority of the people there are still tied to traditional banks. So I believe they hold around 70% of the entire market, the traditional banks. Whereas your fintech companies like Nubank, like Mercado Pago, actually holds only a very small portion of the entire market share. Nubank in particular is around 8%, Mercado Libre, I believe it's around 6%. So the good thing about all these fintech companies is that they can acquire customers at much lower cost. And when that happens, they're able to basically offer more rewards to all these customers to bring in even more customers and steal share away from your traditional banks. So that is another thesis for the company. Last of all, the company is falling because of two different things. First thing is your Argentina macro conditions as well as your elections. So when election uncertainty is over, the stock will probably recover. Besides that, the stock is also falling because of perceived competition by Sea Limited. So if you didn't know, Sea Limited is expanding into Latin America. So Mercado Libre, what they did was they lowered the threshold for shipping. So what that meant was free shipping is actually provided for order amounts that are lower now. The markets are seeing this as Mercado Libre fighting back against potential competition by Sea Limited. So Sea Limited, what they do in Latin America is they lower costs. They're extremely good at lowering costs. They do that in Singapore as well, my main country. I've been asking people why they use Shopee over other platforms, and the main factor is because of cost. So they're doing something similar in Latin America, where they provide the lowest cost, but the most reliable and the fastest shipping is through Mercado Libre. So Mercado Libre lowering shipping costs as a whole is now being seen as competition being a potential threat to Mercado Libre, but an alternative argument would be that Mercado Libre is trying to increase customer loyalty, is trying to basically broaden out its competitive advantage by providing something similar to what Sea Limited is providing as well. So for Mercado Libre, I think it's a company that has a lot of growth ahead of it. And if you're to adjust for their free cash flow number now is around 2.5 billion or so. If you're to remove adjustments due to their credit portion, so it's currently trading at around a 40 times price to free cash flow. 40 times price to free cash flow for a company that is projected to grow its revenue around 30% next year and 25% for the next few years after that is pretty attractive. I'll be doing a valuation soon and a write-up for this company on my Substack. And feel free to check it out if you're interested. I'll be reading up more on this company and I'll tell you when I add a position soon. Anyways, this is Mercado Libre's ecosystem and their flywheel. I hope you guys have found this video useful and invest safe.